Hello, I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we'll provide a market update for October. We'll start with a recap of returns for September and then shift to discussion around recent market breadth, the Federal Reserve, the economic backdrop, and our outlook going forward. September brought another strong month of performance for global stocks, with all major indices in positive territory. Despite a shaky start to the month, the S&P 500 was higher by about 2.1% in total return, while the Russell 2000 was higher by about 0.7%. On the international front, emerging markets were the star performer, up 6.7%. The outperformance of emerging markets can be largely attributed to China's market, which saw a significant rally to finish off the month of September in response to the enactment of several monetary and fiscal measures aimed at stabilizing the economy and economic growth. China's market represents about 25% of the emerging markets index, and after struggling for the past several years, the MSCI China index has rallied nearly 30% in total return so far in 2024. Through September, all major indices sit firmly in positive territory for the year. The S&P 500 index is now higher by 22%, while small-cap stocks are higher by more than 11%. International markets have seen strong returns as well, with international developed higher by more than 13%, and emerging markets up about 17% year-to-date. The third quarter of this year was impressive not only from a return standpoint, but from a market breadth standpoint. We tongue-in-cheek refer to this as a breadth of fresh air, as 9 of the 11 S&P 500 sectors finished the quarter higher. According to the Compound Media, 328 of S&P 500 stocks outperformed the S&P 500 during the third quarter, with only 109 stocks finishing the quarter in negative territory. Meanwhile, small-cap stocks, international developed, and emerging market stocks all outperformed the S&P 500 during the quarter. Now, S&P 500 operating earnings are expected to grow by 13% in 2025, and we believe that this trend could persist if earnings growth broadens as expected, which should continue to support the merits of diversification within equities. September brought another strong month for bond returns as well, as interest rates continued to move lower. The taxable bond index gained more than 1.3% in September, while municipal bonds rallied by about 1%. For the year, both indices are in positive territory, with taxable bonds higher by about 4.5% and muni bonds higher by 2.3%. The most recent Fed meeting for September brought a major shift in monetary policy, as the central bank enacted a 50 basis point rate cut, which brings the upper end of the Fed funds rate down from 5.5% to 5%. This pivot in policy comes as the Fed shifts its focus from stomping out inflation to steering the economy away from a recession. Inflation has cooled significantly over the past couple of years, and after peaking at more than 9% in 2022, it currently sits around 2.5%. Looking ahead, the futures markets are pricing in 75 basis points of additional rate cuts between now and the end of the year. And further out, the markets expect to see as much as 200 basis points or 2% in rate cuts by the end of next year. This would leave the short-term interest rate at about 3% by the end of next year, which is a significant move lower from the peak of this cycle of 5.5%. So for investors parking cash in money markets, CDs, and other short-term instruments, these rates are likely to move considerably lower over the next several months. Shifting to the economy, recent economic indicators suggest that a recession is not imminent. With that said, the risk of a recession will largely depend on the Fed's ability to navigate this soft landing appropriately. The final estimate of second quarter GDP showed that the U.S. economy expanded at a 3% annualized rate. And looking forward, the Atlanta Fed's GDP Now model projects real GDP growth of 2.5% for the third quarter of this year. Looking further out, economists forecast GDP growth around 2% for the foreseeable future, which highlights a slowing but still growing economy. On the labor front, the most recent non-farm payrolls report showed that the U.S. economy added 142,000 jobs in August, which is a solid number, but well below the rate of increase seen earlier this year. We've also seen some significant revisions lower to previous numbers, as represented by the red bars in the chart. Meanwhile, the unemployment rate has moved higher from around 3.5% in the spring of 23 to 4.2%. In aggregate, this indicates a normalization of what had been a red-hot labor market coming out of the COVID-19 pandemic. Looking ahead to the final quarter of 2024, we must confront the elephant in the room, which is the fast-approaching presidential election between former President Trump and current Vice President Harris. As we navigate this environment of heightened political polarization, we focus on providing independent market research regardless of which political party or candidate is in power. For investors, it is crucial to sift through the noise of partisan politics and focus on the facts. And historically speaking, investors are often on edge leading up to Election Day, leading to elevated volatility in the markets. However, this is typically short-lived, and the markets have tended to rally in the months following Election Day. Both candidates face the challenges of a slowing economy, growing national debt, and heightened geopolitical tensions around the globe. But regardless of who takes office, the path forward for the markets will be influenced by corporate earnings growth and the direction of the economy. That is, policy matters and not politics. And we urge our clients to vote with their ballot, not their portfolio. So that's what we have for this month. Thank you for watching, and have a great day.